Stop. Before you scroll past this, there's a version of your life where money is never the reason you can't do something, where you don't lie awake at 2 a.m. doing math in your head, where an unexpected bill doesn't trigger quiet panic. That version isn't a fantasy, it's a decision. And most people never get there not because they're lazy or unintelligent, but because nobody ever sat them down and told them how money actually works. Today, I'm going to tell you that truth. Not theory, not jargon, the truth. Let's go. Think about how much time you spent in school. Thousands of hours, years of your life. And somewhere in all of that, did anyone teach you how to build wealth? What a stock actually is? Why a savings account might be making you poorer? No, school taught you to be a good employee, not how to grow money. That's a real generational problem that has kept ordinary people financially stuck, not because they failed, but because they were never given the tools. Here's what that looks like. You get a job, open a bank account, start saving, feel responsible, and quietly your money starts shrinking, not because anyone stole it, but because of inflation, the most polite thief you'll ever meet. It doesn't knock on your door first. Think about something you bought 5 years ago, a grocery run, a tank of gas, a meal at your favorite spot. Now think about what that same thing costs today. That gap is inflation doing its work. Prices are designed to rise roughly 2 to 3% every year. That sounds small, but here's the math that should wake you up. If your savings earn almost nothing while inflation runs at 3%, you're losing 3% of your purchasing power every year, quietly, like a slow leak flattening a tire overnight. The balance looks the same. What it can buy keeps shrinking. The only weapon against this is making your money grow faster than inflation eats it. That means investing. I know that word makes some people nervous. It sounds complicated, risky, like something for people in suits on Wall Street. But stay with me because what I'm about to show you is so simple, it's almost embarrassing. It's called compound growth. And once you truly feel what it means, not just understand it, but feel it, everything changes. Here's a story. Two friends, same age, same income. Marcus starts investing at 22, puts in $200 a month for 10 years, then stops completely, never adds another cent. Daniel waits, finally starts at 32, invests the same $200 a month, but keeps going for 30 straight years. Who ends up with more? Marcus, by a significant margin, despite Daniel investing 3 times as long and putting in far more total money. The answer is time. Marcus's early years of compounding end up worth more than decades of catching up later. This should make you feel urgency, not panic. Every year you wait isn't just a year of missed returns. It's a year of missed compounding on those returns, compounding on the compounding. The math doesn't care about your excuses. It doesn't care that you were busy or that you didn't know. It just keeps running, with you or without you. So, you're ready to invest. Now what? This is where most beginners make their first big mistake. They hear investing and immediately think stocks, picking individual winners, finding the next big thing. But here's the reality nobody wants to say. Most people who try to pick individual stocks lose, not because they're stupid, but because it's genuinely, brutally hard. Even professionals with Ivy League degrees, billion-dollar research teams, and decades of experience mostly fail to consistently beat the market. Imagine buying an unstoppable, beloved tech company at its peak, then watching it go sideways for a decade while you wait to break even. That's happened to real people with real safe bets. The smarter move? Instead of betting on one horse, own the entire race. That's an index fund, a single investment holding tiny pieces of hundreds or thousands of companies. If one struggles, it barely matters because you own so many others. As the economy grows, your investment grows with it. Low fees, simple strategy, and historically, it has made ordinary people genuinely wealthy. It's just not exciting enough to go viral. Now, let me address the voice in your head right now. The market seems high, maybe I should wait for a dip. I hear you. That logic feels smart. Buy low, right? But here's the problem. Nobody, not analysts, not economists, not the guy on financial Twitter with 100,000 followers, consistently knows when the market is high or low relative to where it's going next. And while you wait for the perfect moment, the market keeps moving.
Here's a number that should permanently change how you think about this. Over the last 30 years, missing just the 10 single best days in the market would have cut your total returns in half. 10 days out of thousands. You don't know which 10 days those will be. Nobody does. The only way to catch them is to already be in the market when they happen. There's a strategy that removes all of this stress completely. It's called dollar cost averaging, and it's almost embarrassingly simple. You pick an amount you can afford and invest that exact amount on the same day every month, no matter what the market is doing, no matter how you feel. High prices buy fewer shares, low prices buy more, it averages out, and you never have to stress about timing anything. Automate it, forget about it, and let time do what it does best. Here's a question that might make you a little uncomfortable. What if the next 20 years don't look like the last 20? Go back to 1900. Britain was the most powerful economy on Earth, and putting everything into British stocks felt like the safest, most obvious decision imaginable. Jump to the 1980s, Japan was the rising superpower, growing at a pace that made America look slow. Serious investors moved money into Japan, convinced it was the future. Then the world changed again. The lesson history keeps teaching over and over is that no single country stays on top forever. Economic power shifts, sometimes slowly, sometimes suddenly. Right now, the American market is dominant, and that's been incredible for investors. But building your entire financial future on the assumption that one country always leads the world is a risk you might not even realize you're taking. A globally diversified investment doesn't require you to predict the future, it just makes sure you're invested in it, wherever it unfolds. You don't have to be right about who wins, you just have to own a piece of all of them. Something else most beginner investing content skips, a massive technological wave is reshaping every industry, and the biggest, most famous companies riding it are priced as if they've already won. Any stumble could send them crashing. Picture two coffee shops on the same street, one massive, famous chain everyone talks about, and a small local place with equally good coffee at half the price. Over time, as people notice, where does the growth happen? The biggest opportunity isn't always the obvious one. It's often the smaller, overlooked companies quietly solving real problems without the hype already priced in. This doesn't mean abandoning big players. It means not putting every egg in one loud, crowded basket. One more thing that might sound old-fashioned, gold is having a moment. Not because it's trendy, but because central banks and sovereign wealth funds, the people managing trillions, are buying it at a pace not seen in a generation. Gold doesn't grow like a stock or pay dividends, but it holds its ground when currencies weaken and markets panic, as it has for thousands of years. Think of your portfolio as a house. Stocks are the walls doing most of the work. Gold is the foundation you don't see but can't do without. A small strategic allocation, not your whole portfolio, is the quiet, boring move serious investors make. Before I let you go, one more thing, and I know it sounds boring, but please hear me out. Before you invest a single dollar, build your emergency fund.
3 to 6 months of your living expenses sitting in a regular, accessible account. Not invested, not locked away, just there. Here's why this matters more than almost anything else. Imagine you invest your savings. The market drops, which it will at some point, it always does, and at that exact moment, life happens. A job loss, a medical bill, a car that decides to die on the highway. Without that cushion, you're forced to sell investments at the worst possible time, locking in losses and undoing months or years of progress in a single desperate moment. With it, you don't touch your investments. You ride out the storm, stay patient, and when the market recovers, you're still in the game. Cash isn't just protection. In the right moment, cash is power. It's the ability to buy more when everyone else is panic selling. The ability to stay calm when the world is losing its mind. Build the cushion first, then invest, in that order. Somewhere out there is a version of you, 10 or 20 years from now, who will look back on this moment with either deep gratitude or deep regret. Gratitude because you started, stayed consistent, and let time and compounding do their work.
Regret because you felt inspired for a few minutes and then went back to exactly what you were doing before. The difference between those two versions of you isn't talent, it isn't luck, it isn't even how much money you start with. It's a decision made today, right now. You understand inflation now. You understand compound growth. You understand why index funds are one of the most powerful wealth-building tools ever created, why timing the market is a trap, why global diversification protects you, why gold is a quiet form of financial armor, and why your emergency fund is the foundation everything else is built on. You have the knowledge. You have the tools. The only thing left is the choice. So make it. And if this video helped you, if something clicked, if something shifted, share it with someone who needs it. Because the best thing you can do with knowledge like this is pass it on. Because your story isn't over. It's just beginning.